Realtors, how exactly does the mortgage picture change for your buyer when the appraisal comes in below the agreed upon purchase price? Today, I want to walk you through the mechanics of how the mortgage changes and why that change may not be as bad for your buyer as they may initially think. But before we jump into the topic, my name is Steve Doherty. I'm a loan officer in Raleigh, North Carolina at Advantage Lending, and I'm a United States Marine Corps veteran. I am licensed in South Carolina, North Carolina, and Virginia. So let's explain this using an example. Imagine that your borrower has got under contract with a $400,000 agreed upon purchase price. And that borrower out of the gate plans on putting 10% down so that they will be making a $40,000 down payment with a $360,000 starting loan balance. Then let's imagine that the appraisal comes in at $390,000, okay? $10,000 below the agreed upon purchase price. How is that impacting the mortgage, especially if the seller is not willing to back off of that contractual purchase price? So the borrower is most likely going to want to maintain the same LTV, or loan to value. The loan to value is the inverse of the down payment on a purchase transaction. This is especially important on a conventional loan where monthly mortgage insurance and potentially the interest rate, depending on their credit score, can be tied to that LTV. There can be rewards for a lower LTV, depending on your credit score, in terms of a lowered or improved interest rate. Mortgage insurance is always going to be lower with a decreased LTV. So if the borrower wanted to put 10% down of $400,000, they will now be putting down 10% of $390,000, the new appraised value. In the eyes of the mortgage bank, $390,000 is the new controlling number, right? The bank does not want to lend on anything else aside what the appraiser has determined it is currently worth. That means the down payment is going to be a percentage of that, right? Interest rates, all that risk are based off of value. So now that will all adjust down to the lower appraised value. So mechanically, the borrower is now going to be making a $39,000 down payment. And if they want to complete the transaction, they will be bringing the difference between the agreed upon purchase price and the appraised value. So $10,000. So that means that their cash to close has increased by $9,000 if they want to maintain the same LTV that they had at the start of the transaction.